This is Money Exchange with Andrew Barnett.
Hello, I'm Andrew Barnett and welcome to Money Exchange, Australia's first and only dedicated currency program. My first guest on the program tonight is a man who spent 12 years as an economist at the Reserve Bank of Australia and is now Chief Economist at HSBC. I'm keen to discuss with him if traders' expectations of further rate cuts at the RBA are likely, or is the RBA going to hold fire, and how will this impact the Aussie dollar in the coming months? The euro, we've been talking about its potential demise for a few weeks now, and this week we got the news we've been waiting for. The euro on Wednesday finally turned on its heels and headed back lower, with traders starting to price in a likely increase to the current European Central Bank stimulus program following weaker than expected inflation data. Joining me shortly from London to chat about the recent turnaround on the euro is Zachary Latif of TLG Capital. Plus, I'll share with you my big currency movers and give you a chance to win $500 cash with our weekly currency quiz question. Plus, we'll be answering your currency questions live on the show. You can email me directly right now via andrew@moneyexchangetv.com. Let's kick things off by first taking a look at this week's headlines. A member of the US Fed has put an October rate hike on the table. Richmond Fed President Jeffrey Lacker is cementing his reputation as an outspoken hawk, and he's told the Wall Street Journal that he doesn't see any reason why the Fed wouldn't make a move this month. He expects to see further labour market improvement and robust consumer spending, and he says this will make the case that the US economy is strong enough to withstand an interest rate liftoff. But Mr Lacker also pushed for a rate hike in last month's meeting and was outvoted by his colleagues. And the focus in the US is on the September non-farm payrolls report, which is released tonight. Economists are expecting the economy to add 200,000 jobs during the month, with the unemployment rate tipped to remain steady at 5.1%. The Federal Reserve is expected to closely watch the data, as it will be the last official labour market print before they make a decision on the cash rate later this month. And we'll have more insight on these looming figures later in the show. My first guest on the program tonight is joining us from our Sydney City CBD studio and is Chief Economist at HSBC for Australia and New Zealand, Paul Bloxham. Paul, thanks so much for your time this evening. We've got an RBA rate decision next week, no expectations of a rate cut, but for those currency traders, what can we potentially expect in the statement from Mr Stevens?
Well, certainly we agree. It's not likely to be eventful. We do think the RBA will be on hold next week. And we think the whole idea that the RBA is considering further cuts is unlikely to come to bear. We think the RBA is going to be quite happy at the moment that the Aussie dollar is doing a lot of the work for them. If you think about it, the RBA has cut interest rates to very low levels. Those low interest rates are doing a lot of what the RBA would have expected. They're lifting house prices, they're lifting the housing construction cycle. We even got retail numbers today showing that retail sales are continuing to grow because households are filling their new and more expensive houses with more retail goods. And the RBA for quite some time has wanted the Aussie dollar to be the mechanism through which growth continues to rebalance, for the Aussie dollar to fall to support that rebalancing of growth. Well, that's exactly what they've gotten over the last few months. The Aussie dollar is down on a trade-weighted basis of 6% over the past 3 months, 15% over the past year as a whole, and the Aussie dollar is now at a level that is supporting that rebalancing of growth. So we think the RBA is actually going to be quite comfortable. If anything, they'll be quite positive, and that may even see a bit of a lift in the currency.
So, Paul, do you see any expectation of the Aussie dollar moving significantly lower in the next 12 months? So where's your forecast, say, this time next year for the Aussie? Is it closer to 60 than 70?
Well, we actually have the Aussie dollar at around about fair value now. We think 70 cents is about fair value for the Aussie dollar. And we do think the Aussie dollar is probably going to stay around that level. Of course, it moves around on a regular basis, so it may be volatile around a steady level, but we think that fair value for the Aussie dollar will continue to be around about 70 cents. So unlike other forecasters who are expecting the Aussie dollar may fall or may fall dramatically. We actually think that we're pretty close to where the Aussie dollar should stabilise at this point in time. Now, backing up that story, a part of it is that we think that the Chinese economy is also showing signs of starting to stabilise. The property market's stabilising and property sales are starting to lift. We think that's going to be supportive of growth in China into the fourth quarter and into next year. So we think Chinese growth will actually lift a little bit into next year rather than fall further. And so that, we think, will provide some support for demand for commodities. And then, of course, those commodity prices are quite important for working out where you think the Aussie dollar's headed. So we think that's going to be quite supportive of the Aussie dollar around its current levels.
What about commodity prices, Paul? Obviously, currency traders looking at interest rate differentials, commodity prices, and a lot of people have been pretty bearish on the Aussie economy in the last year or two. And I know you have a slightly differing view. Do you see commodity prices stabilising around these levels, or are we potentially going to go back and test those lows of earlier this year?
Well, the key ones, of course, for Australia are iron ore in particular, has actually been quite steady for the past 2.5 months. It's been sitting around $55 a tonne, and I think it's been quite a surprise to some of those more bearish commentators thinking that the iron ore price might fall further or fall dramatically. It's actually been fairly stable. We expect that to continue to be the case. We think the iron ore price will sit somewhere between $50 and $60 a tonne. Coal prices have been weaker, of course, and that we do think things will stabilise sometime soon, but they are likely to stay at quite low levels. In broad speaking terms, we actually have in mind that the commodity prices haven't got a lot further to fall, and that's partly due to the story I've already described about having Chinese growth lifting a little bit into next year. If that's the case, and that's what we've got in mind, then we think the Aussie dollar isn't probably too far off its trough.
So what about the comments made by the IMF this week? I see that they're talking down the Aussie economy a little bit, talking about potentially the government needing to perhaps not focus as much on the surplus and get economic reforms through Parliament, increase productivity, or we potentially might see a lower standard of living in Australia. What do you make of their comments this week?
Well, this is nothing new. We've seen lots of commentary in this sort of regard. Productivity growth has been quite weak in Australia in recent years. A part of that is likely to reflect that we haven't had a particularly strong reform agenda. Perhaps the new Prime Minister is able to get a reform agenda off the ground a bit more, and that's going to lift our potential growth rate. But at the same time that the IMF's saying that, and it's repeating a lot of the things that a lot of other economists have been saying, including myself, for quite some time, at the same time that they're saying that, they're actually forecasting that growth in Australia will lift next year. They have in mind growth picking up next year and over the next few years. So they're actually, at the same time they're saying we need reform in order to get the economy to grow, they're also saying that's likely to happen, and we do think growth will lift from here.
Paul, you're the chief economist at HSBC for New Zealand as well. Graham Wheeler's dropped rates a few times this year. Is he likely to drop rates again between now and Christmas? And what are your thoughts about the Kiwi dollar?
Look, we do think that the RBNZ is likely to cut again. One of the things that has been a challenge for the New Zealand economy has been that inflation has been exceptionally low. Despite the fact that growth was actually quite strong through all of last year, inflation has stayed stubbornly low. So that saw them reverse course this year. They've already cut 3 times, and we do think they'll deliver another cut before the end of the year in order to try and get that inflation to lift. Now, it's not to say that the economy is doing terribly. It is slowing down a bit from last year, but it's still doing okay. It's just that inflation just has not shown up. So we do think that the RBNZ is likely to deliver another cut. Now, with that in mind, we do think that the New Zealand dollar is also likely to stay on the weaker side. It's already come down a fair way. That's going to be helpful for growth in New Zealand. So if anything, there's probably a little bit more downside, although it is worth keeping in mind that another cut from the RBNZ is pretty much fully priced. So it probably is largely reflected in the current level of the Kiwi.
And there's speculation around, obviously, the US Fed likely going to raise rates between now and Christmas. As a currency trader, should we be expecting that the Aussie dollar should weaken on the back of an interest rate hike from the Fed, or is all of that now priced in and we're likely to sort of drift into Christmas around about the levels we are now? So if we're bearish on the Aussie, or someone's bearish on the Aussie watching the program, do you think they're going to need a rate hike from the US to see the Aussie lower?
Look, I think you've got to be very careful with this trade because in the scheme of things, it is the case that the Fed is expected to lift rates before the end of the year. The market has that priced in. So the market probably also has that priced into the currencies. It would be potentially the case the Aussie dollar doesn't fall a lot further. Keep in mind the Aussie dollar has fallen a long way already. So a lot of that pricing of the Fed lifting rates is probably already in the market, and that's part of the story we've got in mind. Now, the surprise would be if the Fed didn't lift rates before the end of the year, or indeed didn't lift until perhaps later next year, in which case there could be a bit of upside for other currencies. But that's not our central case. We do think the Fed will get going, and of course in a few hours' time we get to see the next payrolls print to see exactly, to give us a bit more of an idea as to what the timing might be for the Fed.
Paul, as always, thanks so much for your time this evening.
Thank you.
After the break, we'll cross to London to chat with Zachary Latif from TLG Capital about the recent change in direction for the euro, and is now the time to get short on the currency. Don't go away.